In just a few hours, the U.S. Federal Reserve will hand down its closely watched interest rate decision, and it is expected to raise its key lending rate to the highest level in 22 years, just 1 month after hitting pause on a historic spate of increases. Now, economists are predicting the possibility of another increase this year. The rates could be hiked by a quarter point to the 5.25 to 5.5% range. An increase this time would mark the 11th since March last year. Investors will also be looking for more details around another potential hike. This tightening cycle has been the Fed's most aggressive in 40 years, and it appears to have managed to tame inflation in the world's biggest economy. Consumer prices rose at the slowest pace in more than 2 years last month. Still, at 3%, June's inflation is above the Fed's official 2% target. So investors see Wednesday's decision as almost certain, but they do expect no additional increases.
I think the Fed needs to stay the course. We talk to investors a lot about the fact that adjusting, the rate environment is akin to changing the temperature on the thermostat in your home. It doesn't react immediately. And so the Fed is really using old information every time it makes its adjustments, which is why the market at the last meeting predicted that they may be done, and now is starting to really think that we're going to see no retraction through year end. And so I predict that they raise another quarter basis point, and this is the last time they do it.
The U.S. has been sort of the forefront of the concerns about the inflationary pressures, because they would have this, sort of demand-led inflation pressures that I think are more of a concern on how to address it, and really kind of need central banks to really slow down the economy more. So I think that inflation problem in the U.S. has been kind of like the most concerning. But at the same time, I think the recent data points have really turned trending in a really good direction. The last number that we got a couple of weeks ago was quite encouraging. And in fact, I think, the way we would look at it is when you break down the inflation numbers, there's not that many parts of it that are really sort of driving numbers up anymore. A lot of it looks like it's set to come down quite at a good rate in the second half of the year.
And right here in Asia, economists are predicting that central banks may soon decouple from the Fed's tightening cycle. Morgan Stanley sees inflation across much of Asia returning to policymakers' comfort zones, allowing central banks in the region to begin cutting interest rates in the final 3 months of this year. Now, the People's Bank of China has already embarked on an easing cycle, cutting the 1-year and 5-year loan-term rates by 10 basis points last month. Beijing has further hinted at more policy measures in the days ahead as authorities step in to bolster the country's faltering economy. A real-time survey conducted by Nomura's research team says that 32% of respondents expect South Korea's central bank to be the first to cut rates, followed by Indonesia, the Philippines, then India.